this. Okay. What happens when an order block fails? All right. So if price was being bullish here, right, making higher lows, return to order blocks. These are all return to order blocks. Return to order blocks. Right. All of them are return to order blocks. Higher low, return to order block. Higher low, return to order block. So meaning all these order blocks worked. They were pushing price up. All of these order blocks, they were pushing price up. None of these order blocks failed. They were all pushing price up, right? So what usually happens is when we get to this area, let's say this is the area of reversal, like a daily order block or weekly order block, right? And so we are going to get a reversal on the lower time frame, right? Which is our 4 hour and 1 hour. Like I taught you in lesson 1, the type 1, type 2 reversal. So now we're going to include the order blocks. So when price makes a higher high, then a higher low, then makes a higher high, then it makes a higher low, right? So let's say there are early sellers here, people who sold early, right here, and put their stop losses above there. Another example can be this was also, there was an old high here. Could have been yesterday, last week, here. That's on the same level as this, this where price is right now, here, right? So we have almost like equal heights. So some people will sell here, right? Put their stop loss above. So if the market, or no, so if the institutions notice that there's a lot of money up here, okay, for example, let's say $500 million of stop losses that's up there. What they're going to do is, when price comes down here to make a higher low, this order block here, they are going to buy. They're going to use this order block to buy. So this order block here, this one. They're going to use that order block to buy. But this buy is a manipulation, right? They are buying to take out all those stop losses. Okay, so they're doing two things. Number one, they are buying to take out all the stop losses up there, right? So maybe this buy can be like $100 million, $100 million order, right? Just to manipulate the market up to buy, right? So what they're doing is, number one, they're buying to take out all those highs. Number two, they are inducing buyers to continue buying. So they want people to continue buying here. Buy, 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 buy. That's what they're also doing. That's the second part. Now, once the institutions have enough money, they've taken all those highs, they now have the money, what they'll do is they'll break market structure, right? Which is our type 1, break market structure. So now everyone who was buying earlier here is now trapped. They have trapped everyone up here. Meaning now all these guys, they are now in loss. Okay. So they took money twice. This stop losses and these guys twice. Now this order, which they entered into the market, this buy order, is now in loss. Since price came down here, it was a buy, right? So price is below the buy level. It's now in loss. They are now in loss. They need to close that loss at break even. Okay, at the same price they entered. So what's happening is price will come back to mitigate the loss. Once they close their loss at break even, price falls down. So that's what we call a breakout order block. A breakout order block is used to take out liquidity. Stop losses, we call them liquidity. That's what we call it. When people talk about liquidity, it means stop losses. Liquidity. It means stop losses. So the breaker is used to take out liquidity, number one. And then number two, that order block is going to fail to push price up. All these order blocks, these ones, we're pushing price up here. This one pushed price here. All of these, they were pushing price up. None of them failed, but this one failed to push to make price make a higher low here. There was supposed to be a higher low here, but there was no higher low. This order block failed. So now this becomes what we call a breaker order block. An order block that takes out liquidity, and then number two, it fails to push price up, or if it was a downtrend to push price down. Right. So that's what we call a breaker. A breaker is found in type 1. Both type 1.1 and 1.2. That's where you find a breaker. So remember, breaker, number 1, used to take out liquidity, take out stop losses, either with the BMS or with a wick. That's like in type 1, 1.1 and 1.2. Then number 2, it has to fail. It's going to fail to make a higher low, a lower high. If it was a downtrend, it was going to be like this: lower low, lower high, return to order block. Lower low, lower high, return to order block. So now the stop loss is down here. They want to take them out. Then this order block here, they will sell to take out those lows. Okay. Number 2, they are inducing sellers to sell. Sell, sell, sell. We are selling. Then once they have enough money, they break market structure. Now, this order block here was used to take out this low, and also it failed. Price failed to make a lower high there. There was supposed to be a lower high, but it failed, and there was a BMS. So that becomes a breaker order block. That's what we call a breaker order block, right? So both in type 1, type 2, but most of the time you get them in reversals. Okay, so you get a breaker at a reversal, or okay, I'll show you the second part where you can find them. So most of the time at the reversals. Then a mitigation block is found in type 2. Okay, so this is type 1. This is type 2. So same scenario is the breaker, higher high, higher. These are all return to order blocks. All of these return to order blocks. Then we get to the area where we want to reverse, right? When price gets into this level, the institutions will sell here, right here. They're going to sell. This is their first sell orders, right? Their first sell order. They want to sell. Once they sell, price comes down, right here. But let's say there are more sell orders into the market. So let's say when they sell here, another huge sell order comes in, right? But it's up here. Not remember, they don't want to sell low, they want to sell high, right? So they say there are more sell orders into the market. So what they will do is like what they did here. They are going to buy, to do a short-term buy. This one here with this order block to be a short-term buy, right? Why are they buying? They are only buying to push price to premium. Premium. Which premium? Premium of this high and this new low. So what they do, they're just pushing price to premium, not to break market structure, because they already this is the area where they have their first sell orders. So they don't want price to go up there, to go above their sell orders. So what they'll do is they'll just push price to premium, and then once it's in premium, then they put their second sell orders. Now, second sell orders now. Second sell orders. Then once they're done, price break market structure. And same thing, this order block that they used to buy is now, this buy is now in loss. It's a loss now. They need to close it at break even. Price comes back to the order block, which is now what we call a mitigation block. It's no longer a order block, it's now a mitigation block. Then we sell, then price goes down. So in mitigation blocks, the order block does not break market structure, does not take out liquidity. It does not do that compared to a breaker. A breaker takes out liquidity. A mitigation block does not take out liquidity. It only pushes price to premium or discount. If this was the, so this is where they first put their first sell or buy orders. Price goes up, they want to buy again, but they don't want to buy up here, they want to buy low. So they will push price down to discount of this low and this high. What are they? They are pushing price with this order block here. Once they enter their second sell orders here, then price break market structure. Right. So these are the second sell orders for the institutions. And then once the price buys and breaks market structure, they are now in loss. They need to close at loss. It break even. Price comes back to close. Then we also buy with them. That's where we also buy. And then price goes up. So that's what we call a mitigation block. A breaker first takes out liquidity, type 1 or type 2, either with the BMS or with the wick, then it fails. The second part, it always fails. Price will fail to make a higher low or a lower high there. And we get a BMS. That's a breaker. Type 2, order block is just used to push price to premium or to discount. Then we have a BMS. That's a mitigation block. So when price comes back, so when price comes back here to the breaker, we call that a return to RTBB, return to breaker block. So B, when you see me written BB, double B means breaker block. Breaker block. Like order blocks, mitigation block, breaker block. So return to BB. This is a return to mitigation block, MB. Right. And most of the time you see that the order block before BMS was here. This was the order block that broke this low. But they are not going to go up there. Why? Because everyone is trapped here. Because most traders are waiting for price to come back up here so they can close their trade break even. But the market will not go up there. They want to continue trapping them there and get their money. So they won't go up there. But there are times when right. So, but there are times where price will return to the breaker and also the order block. So this was a higher high, higher low. Then this is the BMS. This is your breaker block. So there are times where price will first return to the breaker, then continue to the order block, then goes down. So this was our breaker. And this was our order block. Right. So they'll do two things. Return to breaker and then also return to order block. So in this scenario here, this is a return to order block. You can't say return to breaker. This is a return to order block. This one. With mitigation blocks, I've noticed that majority of the time, 95% of the time, this is the mitigation block. Majority of the time, the mitigation block and the order block before BMS, they're always together. They're always aligned together. Majority of the time, about 95% of the time, they're always together. So you literally know where you're going to take your setup. Your setup is going to be right here, or right here, right there, where they are. Right, and on rare occasions, you can also get a breaker in the order block together at the same. Like if it's a big order block, it can happen. Right. So with the breakers, also remember that with the breakers, the most high probability order blocks are the ones with what I call what do I call it? A violent BMS. Yeah, that's what I call them. There should be a violent BMS. What do I mean by this? One big candle from up here that just breaks market structure down here. Or sometimes there are two. One long candle, then another one. Okay. So what are they trying to do? They are trying to make sure that no one gets out. Or everyone who was buying here, they're trying to trap them. Okay. Because if they move very slow, these guys are going to get out. They will close their trade, they break even. But if they move in full speed, then they're trapping everyone up there. Because remember, sometimes you are busy working, you buy here, you put your stop loss down here, then you go to work. You're not looking at the charts. So they're trying to trap everyone up here. That's what they're trying to do. So the order block that the breakers that have high probability are the ones with the violent BMS, a long BMS. So where else can you find order block breakers and mitigation blocks? So number one, you can find them at the reverse house. Right. Here, breaker, then price comes down. Mitigation block, then price goes down. Now, the other areas where you can get them is on the higher lows or lower highs, right? When, let me just delete this. So at the reversal, mitigation block, breaker block, or if it was an uptrend, you get them here. When price comes to make a higher low, you get something like this, a breaker. Then BMS, when price comes back, you get a mitigation block. Again, BMS. Then sometimes, let's say you have a complex pullback. Okay, let's do this. This is the breaker. Then you have a complex pullback, then breaker block. Then price goes up. So you can get them here, right here. Okay. Also, you can get them on lower time frame. If 1 hour was like this, right? 1 hour was like this. If you go to 15 minutes, here you will find the breakers and the mitigation blocks. Like what I told you last time, that when you mark your 1 hour order block, when price comes back to make a higher low, go to 5 minutes or 15 minutes. You look for type 1, type 2, meaning you are looking for a breaker or mitigation block. Right there. Same in a downtrend. You can get them at lower highs. When price comes to make a lower high, you get a breaker. When they come back again, you get a mitigation block. These are the same areas that you can get there. You can get your breakers and mitigation blocks. So you, depending on the time frame that you are using, you're not going to see, okay, let me say this. From 1 hour going up to our higher time frames, you are not going to see breakers and mitigation blocks every day. Okay, you won't see them every day. If you look at one chart, you might even see 1 or 2. From Monday to Friday, you might only see 1. Let's say you go to 4 hour, you might only see 1 breaker from Monday to Friday on 4 hour. If you go to 1 hour, you might only see 2 only. If you go to daily, you might only see 1 breaker in 1 month, or 2 months, only 1 breaker. Okay, you don't see them often compared to order blocks. Order blocks are every day, but breakers, mitigation blocks, you see them. Okay, on higher time frame, there are few, but on lower time frame, like from 15 minutes to 1 minute, you're going to see a lot of them, sometimes even every day. So now you have to choose whether if you get a breaker setup, trade the breaker. If you get an order block setup, trade the order block. So we have this example here. Price came down to, okay, before I even go there, this was also a breaker. This one. This was a breaker block. Higher high, higher low, break market structure. When they break market structure, what did I say? Mark the order block before BMS. This one. This is the order block. So you expect a higher low, then price goes up. There was no higher low. There was a BMS. So this order block failed. It took this high, but then failed to make a higher low. So that becomes a breaker order block. Right. And then price makes a lower low, lower high, BMS. The moment we see this BMS, this is our order block. So we expect a lower low, a lower high here on the order block. We turn to order block, then BMS, and price continues. So what happened? Price came back to do the return to order block. We could have sold here. Yes, we sell, return to order block, we sell. So now what are we waiting for? We want a BMS of this low. Price comes down, there's no BMS. Then comes back again to premium. So now we are having a range. It is now a range. That's happening. And then after that, we get a bullish BMS. So what happened? This order block was supposed to push price down from here. This order block. They were supposed to push price down from here to break market structure. Price was supposed to break. Then we can say that's a valid return to order block. Yeah, but it is still valid because of this when price came back here. But we were supposed to get a BMS, but there was no BMS. So it failed. So this becomes a breaker order block. It's now a breaker order block. And there was also a confluence. When you look at this uptrend here, this like minor uptrend. There was a higher high, higher low, BMS, higher high. This was the order block before BMS. And there was also a breaker on the same level. So this was the way, so the setup was right here, right there. So what did I say? A breaker is supposed to, first they will break, it will take out the low, and then it will fail. Okay, price is going to fail to make a lower high. That's what happened here. Price failed to make a lower high here. Because if this was a lower high, a good lower high, we were supposed to see a BMS here. Then this will be our lower high, and then new lower low down here. So it failed. That's one of the examples, right? So with the breakers and mitigation blocks, also understand that there are two types. Okay, there are easy ones. There are easy ones that you're going to see clearly, like textbook breakers and mitigation. Then there are some that are a bit advanced. Those ones are not easy to see. So on these charts that I have, I marked both. I was marking both, the easy ones and the advanced ones. Right. So if you see here, this uptrend here, this was the BMS, right? And then we have a new higher high, right? And then you, what did I say? Mark the order block before BMS. It's this one. This is the order block before BMS. So we expect a higher low on that order block, right? So what price can either just come straight down here to make a higher low, or it can do this, the complex pullback, like I told you, higher high, higher low, right? Price can just come down to make a higher low, then break market structure. When they come back to make a higher low, they can give you something like this, the complex pullback, then return to order block, then price continues the uptrend. So if you look here, we had like a small complex pullback here. There was a lower low, there was a lower high, there was a BMS, and there was a lower low, which was the return to order block. And you see, that's why I'm using different color. This is our major market structure. This is the minor with blue. This was the lower low, which was our return to order block, our buy. We would buy here, right? Now looking at this minor structure, this was a lower low. This was the order block before BMS. So we were supposed to get a lower high, then lower low. But that order block failed, and there was a BMS. How did the BMS happen? With one big candle, one long candle, right? So that order block here becomes what we call a breaker. So this was like a minor breaker. It wasn't a major, okay, because it's not part of the major structure. It's part of the minor. It was a minor breaker. So your first buy was here. Your second buy was here. Do you see how they did not even come down here? This was the order block before BMS. Price did not come down here. They only came to the breaker block. Then continued the uptrend. There was your buy. You buy here, and you also buy on the breaker. When we got here, there was a type 2 reversal there. Higher high, higher low, higher high, BMS. This was the mitigation block here. This was the order block before BMS, this one here. As you can see, like I said, with type 2, the order block before BMS and the mitigation block, most of the time they are together, and they were together there. They were together on the same level. And this was the return to order block. Even though it was minor, this was still minor though. It was a minor structure. And then price comes down, we have a new lower low. Now, if you see this setup, this was the order block before BMS. So lower low, lower high, BMS, lower low. This is the order block. So you expect a lower high, then price continues down, but there was no lower high. There was a BMS. It failed. So again, this order block took out these lows, and then it failed to for price to make a lower high. it becomes a breakout order block. So you mark it. Right? So as you can see, when price broke market structure, they came to mitigate. This was the mitigation. This is when they came to close the loss. It was now in loss. They were now in loss. They need to close it. This is when they came to close it. But here they came to close and continued down to the order block down here. They continued going down to the order block. So they mitigated the loss and then continued to go to the order block. This is another breaker also. If you look at this uptrend, it's like a minor breaker. High, low, high, low, BMS, order block before BMS. High, no higher low. This BMS. It becomes a breaker order block. And I think they mitigated it here. Yeah, this is when they mitigated it, when they closed the loss. But they were now in an uptrend. Same thing here. Like I said, some of them are advanced, some of them are minor, some of them are major. Here, high, low, high, this is the order block. We expect a higher low, no higher low. We have a BMS. Look at how the BMS happened. One big long candle to trap everyone who was buying up here. And then this is the return to breaker right there. Another one here again, this one. Price breaks market structure. We expect a higher low. There's no higher low. There's a BMS. So that's a breaker order block there. This was the return to breaker. The order block before BMS was up here. Price did not even go up there. And then now we had a reversal now. This is a mitigation block. Lower low, lower high. Return to this order block, this one, right? So when price return to the order block, they are coming to sell, right? This is the downtrend, so they're coming to sell. So first sell orders, they first sell here. Price comes down, then they want to sell again, but they don't want to sell down here. Price is too low, they want to sell high. So what do? They buy with this order block. Excuse me. Once they buy, price goes to premium of this low and this high. Then they put their second sell orders, then BMS. This order block becomes a mitigation block. So when they came back to mitigate, we can also sell here. We'd also sell here. The same thing that happened here is the same thing that happened here. Same thing, similar. They were both mitigation blocks. But they came to the mitigation and also the order block before BMS. This one, look at this. Price came down, made the lower lows here. These are lower lows, and they are also double bottom, which when retail traders see this, they think of support. So they should buy here and put their stop losses down here. So what did the market do? They use this order block to sell, to take out everyone here. Once they are done, but this, remember, this is now a BMS, right? So these are order block before BMS. So we expect a lower high on the order block. There was no lower high, there was a BMS. So that was this becomes a breakout order block. And they came the next day here. This is when they came to mitigate. So you would have also bought here. You would have bought here the next day when they came back. So don't be sad that you missed your setup. Like here, let's say you saw this BMS and you were waiting for a return to order block. Don't be sad. Because sometimes they will leave, they will break market structure and continue going up. And then the next day, they come back. So just wait for the next day. Or sometimes they will do this in London, then New York price will come back. And never chase a setup. Never do that. Never chase a setup. Never. Like you see price going up here, then you say, oh my God, I'm missing out. Then you start to buy here. And there's no setup up there. Then sometimes what happens, the price then will come back to your order block. And this buy here, which had a stop loss here, you are taken out. If the price goes, breaks market structure and does not return to your order block, it's okay. It's okay. There's another setup in another pay or tomorrow. And this was the return. Another breaker here. This high, this low, BMS, higher high, order block. We expect a higher low, no higher low. We have a BMS. There, violent BMS. To trap everyone who was buying up here. And this is the return to breaker. You would have sold here. So you would have sold here, then also buy here. But this would be more for advanced guys. No, not for beginners. If you are advanced or those guys, those okay, yeah, I can say advanced or those traders who trade 1 or 2 pairs. Because when you trade 1 or 2 pairs, you catch both the buys and the sell setups. Because you are only focusing on 1 and 2, 1 or 2 pairs. All the focus is on those pairs. But if you're trading more than 2, 3, 4, 5 pairs, oh my God, it's not going to be easy for you. This is another breaker, a textbook breaker. But what is the problem with this breaker? What is the problem?
It's a breaker to the upside and to the downside. It's a breaker to the upside and probably a mitigation block to the downside.
Okay. Let's see the answer from our what's forget how to pronounce it. Sanfred, yeah. What's your answer?
Yes.
What's wrong with that breaker? Yes, it was valid. The price came back to the breaker and reversed.
Yeah, that's what I'm looking at.
Why?
Because it seems valid. It broke, and then I actually don't know. I actually would have seen that as a sell setup, because that's a breaker.
Okay.
No.
Lesson number 1. What was it? What was the first lesson I taught you?
Oh, lower low?
No, what's
one?
the first lesson?
It's a type 1 reversal.
Okay, no. This was a bullish trend. And this breaker was on the wrong side of the trend. Okay, that's what happened. This is a bullish trade, as you can see. Price is still bullish. But this was a sell in a bullish trend. So that's what was wrong. Yes, the breaker was valid and it also worked. There was, I think it gave us maybe 10, 20 pips, if I'm not mistaken. Yeah. But still, it was on the wrong side of the trend. That is what's wrong with it.
But in this case, I mean, of course, now we know it's hindsight. But once you come here to the order block itself, you don't know. It could be the end of the uptrend.
What's this? What's the time frame?
So we have to look at a higher time frame. Like
we
4
always
hours.
use 1 hour and 4 hour.
1 hour, yeah.
I don't have the 1 hour 4, but if you go there, you see that we were bullish. We are bullish. So this would have been, yes, you would have taken it, but it was going to be a risky setup. It was going to be a risk because you are selling against a bullish trend. That's what you're doing. You could have taken it, but it's a huge risk. That's the truth. So even if I see, I will never sell this. I don't do that. I always, because sometimes you see what will happen. Price will come here. Then you see this down to this candle here. Price will come down. Maybe this would have been like 5, 10 pips. Then you're like, okay, yeah, I want it to come down here. And then next thing, boom, they take you out. 1 second you look away, you just maybe you go and make coffee, you come back, boom, they take you out. So that's why I don't really recommend trading against the trend. Always trade in line with the trend. Okay. I think you would have bought it. This was a buy here. Okay, this will make sense in the future lessons, but this was a buy. Yeah. And I think they were using also this order block. Yeah. So you would have bought here. This would have been your buy. Never trade against the trend. You get bent. They will burn you. Because they do that. Price is bullish, then they give you something like this. Price comes back, you sell, then they just come down a little bit, even somewhere here, the next thing, one big candle, and they take you out. So it's not, I don't recommend trading against the trend. Okay, we have 1 minute. Okay, let me give you a new link. I'll give you guys a new link just now.